Hi, everybody, and welcome to our lecture on Chapter 22, which is Performance Measurement and Responsibility Accounting. And our course learning objective for this chapter is objective number 9 in your syllabus. It says, explain the nature of and need for segment reporting and the relationship with cost, profit, and investment centers. And we're going to prepare and analyze related segment reports. Okay, so these terms, cost, profit, and investment centers, you've probably heard all those terms before. We'll talk about what they mean in this class. But the key term that I want you guys to keep in mind in this chapter is this concept of segment. Okay, segment meaning a piece of the whole. Okay, so before we get into it, I want to back up a little bit and remind ourselves, what is the purpose of accounting? Why are we doing this? We've talked about this a lot in this class, but the purpose of accounting is to provide information to help make decisions. So one thing that I want you guys to do in this chapter and every chapter of accounting is to always ask yourself, how does this help me make better business decisions? I want you to understand the reason why we're doing it, so you don't get so bogged down in the numbers that you forget why you're doing it and why it's helpful. I think that's really, really key in understanding accounting. So in this particular chapter, the topics that we're going to cover are what is responsibility accounting, the 3 types of responsibility centers, and how they're evaluated. And by evaluate, that means to look at it and go, are they doing well? Are they doing poorly? What are we going to do about it? And we're also going to talk about the terms controllable versus uncontrollable and how they relate to this concept of responsibility. And then, of course, we're going to bring it back to then, how does responsibility accounting help us make decisions? That's what I always want you guys to keep in the back of your mind throughout all of these chapters is how does this help us make decisions? So I'm going to ask you guys a question about a little trivia about my favorite store ever, which is Target. How many stores does Target have? Does anyone know? I'm sure you could Google it or ask Alexa, but I will answer it for you here. Target has 1,868 stores, which is awesome because I love Target and I'm happy to hear that they have stores. And last semester when I gave this lecture, it was only 1,850, so they've increased by 18 stores, which is pretty awesome. So this guy right here, this is Brian Cornell. He is the CEO of Target. Now, do you guys think that he is there at every single one of those 1,868 stores making decisions on who's going to work at the store today? How are we going to schedule them? How are we going to, make sure that certain employees take their lunch breaks? Do you think he's there doing that? Well, come on, of course not. That is why Brian Cornell has hired a bunch of people below him, okay, who are going to manage all of those individual Target stores because he can't be there to do all of that. So even though he is overseeing either directly or indirectly all of these people below him, he can't be there to manage them, okay? And that is the whole premise behind responsibility accounting. Okay, we need responsibility accounting because businesses are big and complex. There are a bunch of different pieces and moving parts going on, and it's impossible for one manager to manage all of it. Like, yes, I know Brian Cornell manages all of Target, but not at that detailed level that each of the individual stores need. So in order to deal with that, we make those big complex businesses easier to manage by dividing them into responsibility centers. Okay, and each of those responsibility centers has its own manager who's in charge of that piece of the business. Okay, so you've got like this little picture here kind of illustrates that. You got the CEO at the top, and then he's hired a bunch of managers below him who then in turn manage the people below them so that he doesn't directly have to manage everything. Okay, now there are different terms that can be used for these pieces of the business, okay? And every company calls them something different, okay? So some companies may call them units. Some may call them divisions. Some may call them segments. Again, that term segment, right? A piece of the whole. Some may call them departments. Some may call them sectors. So I used to work for Northrop Grumman, which is an aerospace company. So they made aircraft, they made spacecraft, all kinds of cool things. So this term sector sounds really like technical, and it worked very well for them. So they called them sectors. But all of these terms are just terms for the same thing, meaning responsibility centers or segments or pieces of the business. And how responsibility accounting helps us is this. It tells us by breaking up the business into these small pieces and getting reporting on each of these pieces of the business, it tells us how each department contributes to the revenues and expenses of the company as a whole. Okay, how do each of these stores help Target overall to make money? And then it also helps us to measure the performance of each department and evaluate the managers. Okay, so it will tell us if a segment is doing well or not. If they're doing well, we're going to say, yeah, we're going to promote that manager. We're going to give them a raise. We're going to learn from that department that's doing well, and maybe they're doing things that the other departments should be doing. Or if they're not doing well, I don't know, maybe we got to give them the boot. We're going to fire them, right? Well, I mean, hopefully not right away. Hopefully you'll give them some chances, give them some opportunities to learn and develop. But it alerts us to areas of our business that are weaker that we need to work on. Okay. If you just have everything in one big lump and just put all the numbers together into how is the company doing overall, it doesn't really give us as much good information. It's much better to get information on each segment so we can dig deeper and figure out what specifically is going well and what needs to be worked on. Now, responsibility centers can be based on a bunch of different things. Okay, so for example, you could divide up your business by location. Okay, so take a map of the country, and this, anything in this area is the West region, anything in this area is the Midwest, so on and so forth. Okay, that's one way to do it. Another way to do it is by product line. So there was an example in your book about Callaway Golf, and actually one of my friends who's a former coworker of mine actually works for Callaway in their accounting department. They're located down in Carlsbad, and so they make obviously a bunch of different golf products. So they might divide up their company by product line, right? So they're going to have the golf club department and the golf ball department, and each department is responsible for the decisions related to manufacturing and selling golf clubs versus the decisions related to manufacturing and selling golf balls. Okay, you could also divide it up by function. Okay, that means what does the department do? So for example, within a business, you've got the sales department. Well, they're responsible for selling stuff, and you're going to have the sales manager who's then responsible for all the sales reps below them. You'd also have the accounting department, my favorite department of all, right? They're going to be have a manager who's responsible for all of the accountants below them, and they're responsible for providing financial information for the business. Same thing with HR. They're responsible for making sure all the paperwork is filed for their employees, that they have their benefits, that, all of that, their training and all that stuff is done. And so they're going to have an HR manager who's in charge of all of the HR people below them. So these are just three, different possible ways that a company could divide up their business, okay? Either by location, by product line, or by function, or even a combination of these. Now, there are three basic types of responsibility centers, okay? Cost center, profit center, and investment center. Now, a cost center is a segment of the business that incurs cost but does not generate revenue, meaning they don't sell anything. Examples of this are manufacturing departments, right? That's your factory where they're going to be making stuff. Now, the factory, the guy who's in charge of managing the factory is not also then responsible for selling the product. Okay, so they're just responsible for the cost of manufacturing, but they're not going to sell the product. So in that case, they incur costs but not revenue. Another example are what we call service departments. Service departments are areas of the business that provide a service to the business overall, but they don't sell anything. So, for example, accounting, my favorite department, they're responsible for providing financial information, but they don't sell anything. HR, they're responsible for making sure all the paperwork is filed and the benefits are set up, but they don't sell anything. Advertising, even. Okay, so advertising, you might think they sell something, but they don't actually sell anything. It's the salespeople who sell stuff. The advertising department just makes decisions as far as what kind of ads are we going to run. Are we going to do print ads? Are we going to do TV ads? Are we going to do radio ads? And they're responsible for developing the ads, but they don't actually sell the product themselves. Rather, they provide a service to help the business, okay? The next type of responsibility is a profit center. And as we've learned in class and back in financial accounting, profit means revenues minus expenses. So therefore, profit centers are responsible for both revenues or sales and costs or expenses. Okay, so they've got both going on. Okay. However, they are not in charge of any investment funds, and I'm going to explain next what I mean by investment funds. But for now, let's just focus on the the revenues and the costs. Okay, so examples of those would be things like stores, right? All of those Target stores, they're responsible for selling the Target product, but they're all going to have also going to have costs. They're going to have, the employee salary or those employee wages. They're going to have, the various costs associated with that. So the stores both sell stuff and they incur costs. In addition, are product lines. Okay, so that means for if you're in charge, which I was talking about Callaway Golf, right? The golf club division, they're responsible for both producing and selling golf clubs. Okay, because if it's by product line, then it's like everything related to that product line. So they're supposed to sell the golf clubs. That's the revenue, but they also have to manage the costs of manufacturing those golf clubs, okay? And last is investment center, okay? An investment center is sometimes the hardest for students to understand, so I'm going to hopefully try to explain it well here, okay? So investment centers both incur cost and generate revenue. However, I want you to realize that this may be indirect. Okay, they may indirectly generate revenues. So let me give you an example. So my example is higher level managers in charge of several different profit centers. So here's an example. Let's say Target, and I don't even know for sure if Target does it this way, but if they did. Okay, Target has a West Coast manager who's in charge of all of the different stores on the West Coast. And I'm just giving examples. These are stores probably close by us. Mission Viejo, Laguna Hills, San Juan, San Clemente. Okay, but there's a West Coast manager in charge of all of these stores and many, many more on the West Coast. Okay, now, the individual stores, like we talked about, are profit centers, meaning they are responsible for selling the goods, but they're also incurring the costs related to what's going on in their stores. Okay? Now, the West Coast manager, he's not actually in the stores, but he manages, he's responsible for the store. So, therefore, he's a higher level manager in charge of several different profit centers. So, he is indirectly in charge of the costs and revenues from each of these stores because he manages them. You guys see the distinction? Okay, how it's indirect. He's not actually in the stores. He's just, but he manages all of these stores. Okay. In addition, and what makes him an investment center is that he's responsible for deciding on investments in operating assets. Now, what I mean by that is buying more long-term assets. So in this case, if it's Target, he might be responsible for opening a new store. So he's going to decide, should we open up a new store somewhere on the West Coast? Okay. Whereas like the Mission Viejo store manager, he can't decide to open a new store. No, he's only in charge of his own store. The West Coast manager, however, can decide if we're going to add additional store locations. So that's what makes him different than a profit center, is that he can make those decisions to invest money into additional assets such as a new store, or for example, buy a new manufacturing plant or buy new equipment or something along those lines. Okay? So I'm going to continue this lecture in the next video.